Today, we're opening up the professional trader's playbook. We're going to break down 4 completely different strategies for trading a market giant, Alphabet.
All right, let's kick things off with a dilemma that every single one of us has faced. A stock you really like is hitting new highs, day after day. You feel that FOMO kicking in, right? Do you chase it? Do you wait for a dip that might never come? Or do you just walk away? It's tough, but it doesn't have to be a guessing game.
You see, there are disciplined, systematic ways to handle this exact situation. So today, we're going to use Alphabet as our live case study to show you exactly how a pro would analyze the situation and, more importantly, execute a plan. So let's dive in.
Okay, so first things first. Before we make any moves, we've got to ground ourselves in the facts. We have to understand the current technical landscape for Alphabet right now as of November 21st, 2025.
As of our analysis, the stock is trading at $300.88. Keep that number in your head because it's the anchor for everything we're about to talk about.
And this is why we're talking. It's hovering just 2% below its peak for the entire year. You see, that kind of strength is like catnip for momentum traders, but it makes anyone looking for a bargain, well, pretty nervous.
Now, if we dig a little deeper, this chart tells a really powerful story about the stock's health. It's trading way above all its key moving averages. I mean, look at that. It's a whopping 50% above its long-term 200-day moving average. That's not just a trend. That is some serious, powerful momentum. You just can't argue with that.
Okay, so you see that momentum. How do you play it? Well, our first strategy is for the bulls, the aggressive trader who wants to jump on that moving train. Now, fair warning, this is a high-risk, high-reward play.
And let's be crystal clear, this is not for the faint of heart. This is tailor-made for a trader with a high tolerance for risk, someone with a short time horizon, maybe 3 to 6 months, and who has the guts to buy a stock when it's already flying high.
So what's the actual game plan? You get in right now at the current price. But, and this is absolutely crucial, you immediately set a tight stop loss just over 7% below your entry. That's your safety net. It protects you if things go south. And you don't just swing for the fences. You take profits in stages, locking in those gains as you go.
Okay, but what if buying at the peak just makes your stomach turn? What if you're a more patient investor? Well, there are a couple of other paths. Let's look at 2 different strategies for those who'd rather wait for a sale.
Now, this first one, it's the one I'd recommend for most active investors out there. Instead of chasing, the whole idea is simple. You let the price come down to you. You're aiming to buy on a pullback, right at a level where the chart suggests there's a strong floor of support. That gives you a much better risk-to-reward ratio.
So here's the play. You wait for a 16% pullback from where we are now. Your entry is much lower, which means your potential upside is higher for the amount of risk you're taking. And you see the discipline here? It's the same pattern. A clear entry, a hard stop loss, and a plan to take profits in stages. All right, now let's talk to the really patient folks, the most risk-averse investors. This isn't about catching a little dip. This is about waiting for a major market shakeup, a big correction, so you can scoop up a world-class company at a deep discount. So what's the difference between these 2 waiting games, technically speaking? Well, the moderate approach is looking for what's called a 38.2% Fibonacci retracement. You don't need to know the jargon. It's basically just a predictable spot where a stock in a strong uptrend often finds its footing. The conservative plan, on the other hand, is waiting for a much bigger drop, maybe to the 61.8% level, or even all the way down to that long-term 200-day moving average we talked about.
All right, that brings us to our final strategy. And honestly, for the vast majority of people, this is the most recommended one. It's a whole different mindset. It's not about being a genius and timing the market perfectly. It's about discipline and consistency. It's called dollar cost averaging, or DCA for short. And the idea is so simple, but it's incredibly powerful. You just invest a fixed amount of money on a regular schedule, say the first of every month, no matter what the stock price is doing. Up, down, sideways, you just buy. It takes all the emotion and guesswork out of the equation.
And that's the real magic here. You're not trying to time the market anymore. When the price dips, your fixed dollar amount automatically buys you more shares, lowering your average cost. It's a less stressful, more disciplined way to build a big position in a great company over the long haul.
Okay, so we've just walked through 4 totally different professional-grade strategies. Now let's line them all up side by side so you can really see the differences and figure out which one clicks with your own personal style. This chart right here is perfect. It gives you the whole picture at a glance. You can see that aggressive play, jumping in right where the price is today. Then you see the moderate and conservative entries, patiently waiting down below for a better price. And DCA?
Well, that's not one point. It's spread out over time, just smoothing everything out. Now, let's get into the nitty-gritty, the numbers. This table breaks it all down. Look closely at the trade-offs. The aggressive strategy gets you in the game now, but it's got the highest risk. On the other end, that conservative strategy has a fantastic risks-to-reward ratio, over 4-to-1, but you might be waiting for months, and that entry price might never even hit. It's all about what you're willing to trade.
Before we wrap this up, we have to talk about the most important part of this entire discussion. These are the golden rules. Because I'm telling you, not a single one of these strategies will work if you don't manage your risk.
These 3 things are non-negotiable. Seriously. Number 1, always use a stop loss. You have to know exactly how much you're willing to lose before you enter the trade. 2, position sizing. Never bet the farm on one idea. Stick to your discipline. And 3, take your profits. When a trade works, don't get greedy. Lock in those gains along the way.
And last but not least, a smart plan always includes knowing when to fold them. You have to be watching for red flags. These are fundamental or technical signals, like slowing growth or a breakdown in the stock chart that tell you, hey, the reason I bought this stock might not be true anymore. That's your signal to reevaluate and maybe get out.
So, there you have it. 4 professional frameworks: the aggressive chase, the patient wait, the disciplined accumulation. The key takeaway here is that there isn't one right answer. There's only the right answer for you. You've got the playbook now. The only question left is, which strategy fits your profile?